Michael Carnevale is branch manager and financial advisor. Securities offered through Raymond James Financial Services Incorporated, 400 Southbridge Street in Auburn, Massachusetts, 1-800-657-9126. A member of FINRA SIPC and are not deposits, not insured by FDIC or any governmental agency, not guaranteed by Webster 5 Cent Savings Bank, and subject to risk, may lose value. Webster 5 Cent Savings Bank is not affiliated with Raymond James Financial Services Incorporated. The information contained in this report does not purport to be a complete description of the securities markets or developments referred to in the material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Any information is not a complete summary or statement of all available data necessary for making an investment decision and does not constitute a recommendation. Any opinions are those of Michael Carnevale and not necessarily those of RJFS or Raymond James. Expressions of opinion are as of this date and are subject to change without notice.
Good afternoon, ladies and gentlemen. It's time for our monthly tete-a-tete with Mike Carnevale, Raymond James representative, and he economically or financially is here to tell us, like Wayne Gretzky said, you want to know where the puck is going to be, not where it is. And so Mike is here to tell us what's happening. I'm your host, Richard Morco. Mike, it was a good month last month.
Second month in a row. We had the big rally off the yearly low of September 30th, and October was up big. November continued that. Dow's up 6%, back over 34,500. So we're less than 2,500 points from an all-time high. But during those dark days of September, we're up almost 6,000 points. So in year to date, Dow's only down 5%. So, if you just woke up, you'd say it wasn't that bad a year. Down 5% after what we saw in 20 and 21, which were both very good years. Interest rates are starting to fall again. During the month of November, most Treasury yields peaked at over 4%, almost to 4.25%. They're all down under 4%, and they're closer to 3.5% today. So, number one, people who think interest rates are going to keep going up and inflation is going to keep getting worse and worse, Treasury market's not saying that. So I think we mentioned this maybe a month ago. I think we got to start thinking things are going to be better rather than getting worse.
Well, your friend, Mr. Powell, okay, he may not be your friend.
Correct.
Mr. Powell has made noises that he's going to slow the increases in the rate. He's not going to go up the full 7.375 per.
Mm-hmm.
So he's basically on your side there.
We'll see on December 14th when they meet. But you're right, the likelihood is the next rate increase will be 0.5%. And then, who knows? That might be it for a few months. It's interesting, month of November, they raised them 3/4, and then he had his press conference, if you might recall. That was the day the market went down over 1,000 points, because they were hoping for some kinder words, and he kind of kept saying, no, we're going to continue with these aggressive rate hikes until inflation comes down. So a lot has changed since, in the last 5 weeks or so. Number one, we've had an inflation report come out that shows that inflation is going down. Now, it's not near the levels that the Fed wants, but, before it can get there, it's got to drop from its highs, and that's at least what it's doing.
Well, being the low life that I am, and unfair completely, it's pointing out inflation isn't going down, the rate of increase is going down.
Oh, correct. So, right.
Right. What a terrible person.
You are. I mean, you don't want the other thing, because that would be the worst case scenario, where prices were actually falling.
Oh, I'd hate that? Yeah, okay. All right, well,
That would be a negative. That would be a big negative.
all right, all right. Now, we are recording this on a very famous date in history.
Yep.
It's December 7th. Now, that is a day that lives in infamy.
Mm-hmm.
Well, right now, what's going on in that stock market, it isn't as wonderful as it was. It's been going down this last week as we're in December.
December, correct.
Things, and in fact, it's going down fairly quickly.
It's all relative. I mean,
This is the
Depends on-
most sunniest disposition.
depends on where you want to start from. If you want to start from September 30th, yeah, I'd take 6,000 points out and then lose 1,000. If you're starting from December 1st, yeah, it's down. All depends on where you're starting from. I mean, things don't always go up, and in the darkest days of September, things didn't always go down either. I don't think anything's changed. Day to day, you shouldn't really get excited.
Day to day.
Day to day.
But the last, 5 days? How many days?
Yeah, that's 3 or 4 days
3 or 4
anyways.
days. Well, how many days has it gone up this month? So here I am. This is not
Maybe
fair.
a day or two.
Okay. So, but this happens. I mean,
Yep.
You've made the point that December is it's January. We will look back at this,
Correct.
and if December is a down month,
Mm-hmm.
it is time to panic a little, because this is heretofore almost always a good month.
Yeah, historically, December is the second best month of the year. That's followed by January as being the best month of the year. But that doesn't mean, and the last 3 Decembers have been up. November historically has been the third best year, and 6 of the last 7 Novembers have been up. So this is a historically strong time of the year. That's why they have that saying, you sell in May, come back on the end of October, and then the following 6 months, 7 months tend to be pretty good on average.
Okay, so I will take off my Dr. Doom cap and let's look at the technicals.
I would. So we've had a 6,000 point rally. So, on the short term, where do you think things can go? Well, I'd like to look at the technical indicators, and there's hundreds of these, but there are 3 or 4 big ones that you can look at every day if you want, and they tend to give an indication of what short-term sentiment is. So you've had a big rally. Common sense would say, well, what do you think the indicator says? They've probably gotten weaker. And that's exactly what's happened. The 200-day New York Stock Exchange moving average, that's the average price of a New York Stock Exchange listed companies over the past year, 200 trading days. It was at 32% a month ago. Now over half the stocks are above their average price. Fair value is somewhere between 40% and 70%. So we're kind of in the lower middle of that. Saying that, yeah, on the short-term basis, stocks seem according to that indicator, seem to be fairly valued. Then we look at volatility. We want to see high volatility because, when do people panic? They panic when prices have fallen, and that generally indicates times of very volatile events. A month ago it was at 25, today it's 19. Historically, anything under 20 is considered less volatile. That's a negative reading. Low volatility is complacency, and so you don't want to see that. Then you got the stochastic oscillator. This is probably the most important indicator right now, because that takes the price of a stock or an index relative to its recent low and recent high points. And it's rated from 0 to 100, 100 being the worst possible rating. A month ago it was 61. We've had a big rally, so what would you think the number would be, higher or lower? You would think the number probably is going to be higher, and it is. It's at 96. Now you want to keep in mind 100 is the worst possible rating. So these technical indicators say that it's been great the last 2 months, but it's taken its toll on short-term potential. So wouldn't be surprised if in the short term, and you don't know what that means, that could be, a week, a month, 2 months, but the next direction probably is going to be flat or down, as opposed to a continuation of this upswing. So as you had said, right, the market's been down in the last few days. You shouldn't be panicking, because the indicators are saying that that's a likelihood. And that's what I kind of look at, and I think what people should look at to be able to, adjust their expectations. And everybody likes to talk about long-term returns, but unless you stay in long-term, you're not going to get the long-term return. And the way you can stay in there long-term is understanding what can happen in the short term. So short-term indicators right now say, they did this at the beginning of the month, but it's relatively the same. The indicators would say, yeah, market's really gone up quite a bit, so it's probably time that it's going to hit a rest area. So if it does, that's not a surprise. Are you still awake?
No.
Okay, good. Then I served my purpose.
And you did it well.
Thank you.
I'm trying to parse this. It's that so we could have a flattening, you're saying.
Correct. Yeah.
And that's a good thing.
That would be a good thing.
Well, then why not go down 20 points and make it an even better thing?
Well, that would depend, of course, if these indicators weakened even more. Right now, it doesn't look like there's going to be a big decline, so I would say, I would classify it as a rest, meaning it could go down a little bit, but it's not going to go back to where it was in September.
Yeah, but you thought I was taking a rest there.
I did.
Yes.
I thought you were asleep, actually, not a rest.
I've shown this man nothing but kindness, ladies and gentlemen. And this is the way he is treated.
I sense what's coming, so I have to prepare.
Okay. So, all right, we're at the flat point.
Probably.
And do you see anything saying bounce up?
Oh, sure. I mean...
I was hoping,
Sure.
I'd be shocked. That would cause me heart failure.
Right. So the technical indicators are just numbers. It's really just math formulas that have been developed over the years that try to show patterns. But that in itself isn't going to be the be-all to end-all. It's that plus what happens with these economic reports that keep coming out. So what could send the market up would be better than expected economic data. That would then change some of the technical indicators. On their own, all things being equal, no major news, the market probably is resting or maybe dropping slightly from here.
Okay.
Of course, there could be positive news coming out tomorrow. That could change all that. These are just used, I think, to control emotions, because that's the worst.
But in negative news,
Could send it down too.
Yeah,
Sure. Oh, absolutely.
Well, we were in a small discussion before we hit the air about the big tech stocks.
Yep.
The biggest ones in the NASDAQ have taken a dive, which is, Amazon's down 48%.
Mm-hmm.
Now, who doesn't buy something in December from Amazon?
Mm-hmm.
Well, I know some people probably don't, who will remain nameless from the studio audience. But you need, even some staples. A lot of people just are always buying.
Mm-hmm.
You would say that's a steady business.
Mm-hmm.
Do you have any idea what happened to all of these stocks? Meta, Tesla. Well, Tesla's volatile. NVIDIA, Alphabet, which is Google.
Mm-hmm.
Any idea what happened?
Well, a year ago in November, the NASDAQ peaked at its all-time high, 16,000 something. And so stocks don't necessarily trade on what's happened in the past. They more trade on what expectations are for the future. So a year ago, expectations were really high. You know, oh, these companies, oh, Amazon is going to take over the world. I mean, unlimited growth potential. So what would you pay? And all stocks trade at it. Their price is determined by a multiple of their earnings. So what would you pay for a company that was doubling earnings every year, going up 100% every year? You may pay more for that than a company whose earnings are doing nothing year over year.
But they are steady.
But they are steady.
Okay.
So a year ago, we were into this market that was paying up for future earnings. You know, we saw this similar thing back when the market really tanked in, I believe it was in 08, 09, where they were no longer pricing a stock or a company on its earnings, but on its revenue. You know, oh, well, we're losing X amount of money. Don't worry about that. We're growing revenue so fast, eventually we'll make money. Well, that for a lot of those companies, that didn't happen, right? Because the free money, the free funding, the venture capitalists finally decided they didn't want to lose any more, so they pulled it. What happened with these particular companies, whether it's Meta, Tesla, Nvidia, Amazon, Alphabet, they were trading at, you know, way above market price to earnings, meaning people were willing to pay more for $1 worth of Amazon's earnings than they were to pay for $1 worth of IBM's earnings. The reason being is there was a perception, oh, Amazon's growing much faster. So eventually what kills all these companies is slowing of growth. So although all those companies are probably going to be around for a very long time, their growth rates may not be as high. And if the growth rate isn't as high, people or the stock market or institutions aren't willing to pay as much for that growth. I think that's what's happened.
I understand that, but when I could see Amazon attaining a reasonable price-earnings ratio.
Mm-hmm.
Something like Meta, that's going down. That should be losing market share.
Mm-hmm.
And Alphabet as well. But Amazon should reach a level and be steady. And NVIDIA, if it is really a good chip company, well, that goes with the technical economy.
Yeah.
You know, if we need more chips, come on, NVIDIA, produce them.
You're right with that. The point you haven't factored in is the percentage growth year over year. There comes a point where Amazon is selling to everybody, so they can't. There's nobody else to sell to. So although they're making a lot of money,
Right.
there's no more growth. And we saw this, you know, in the last so-called tech expansion, where a lot of those companies are still around today, but their stocks are down 50 to 75% from their highs because the rapid growth phase is over.
That makes sense. But, and is that NVIDIA too? I mean, it's a chip
Oh yeah,
company.
I mean some of these NASDAQ companies were trading at, you know, over 100 times their earnings. The market in general trades at around under 20 times earnings. So you were paying, or the market was putting a 5-time multiple on like an Nvidia earning as they would on the Standard & Poor's or the Dow earnings. Mm-hmm. The only way you would overpay for that is if you felt that would continue.
And is the market saying it's reached a plateau, or it isn't growing? It isn't going to grow, or is it? You know, I mean, they come out with the next chip, the next super chip. I don't know.
Yeah.
You know,
The market is saying the growth of the past may not be the growth of the future.
I got to write that down.
Yes.
Yeah.
The other thing is, another good example of that is Intel. Yeah, their chip is everywhere. yet their stock is depressed because there's no more growth. Other companies have entered the market and have taken away, potentially some of their growth. I mean, that's not the only reason, but that's a good reason, I think.
Well, it was the head of Intel that came up with the law about growth on this, that every certain number of months, chip speed would double or something like that.
Right.
What was his name? Andy something or other?
Andy Grove.
Grove's law. Was it Moore's law? Which would
Grove.
Grove's law?
If you're talking about Andy Grove, yeah.
No, there was another guy in Intel. What, Moore?
That I don't know.
We just passed the old age test where memories are absolutely gone.
Yeah. Yeah.
All right, so we had a little discussion about this beforehand. Feds voted to hike in the last month by 75 basis points to 4%.
Yeah.
And Powell gave a press conference. Dow tanks 1,100 points on the need, his comments about a need for higher rates.
Right.
So now he's talking smaller hikes.
Well, it's interesting. He had that press conference after the last meeting back in tail end of November. And then he had his press conference. And then usually a few weeks after that, they release the minutes. And when they release the minutes, they don't name names. They just say, several members said this, a member said that. They don't release the names for years to come. And there was a lot of talk.
So much for transparency.
Right. And so a lot of talk in that meeting was the need for maybe no longer having to have these big interest rate hikes. That contradicted really what Powell said at his press conference. And it was at about that time when the minutes were sent out that the market started to move back up again, off that 1,100 point drop on his comments. So that's kind of interesting. There's probably a little bit of discussion going on, within the voting members as to, how long they should be doing these big rate hikes.
Now, the International Monetary Fund said the war in Ukraine, according to this, the most important negative factor for 2023.
According to them.
Could cost the world economy $2.5 trillion. And President Biden read that and said, I'm immediately calling for negotiations. Not.
No. Again, everybody has their own agenda, right? IMF probably not, really pro-USA.
You think the IMF is not pro-USA?
Yeah, right.
We run it. We own it.
Yeah, but I still would say, they're talking more about, the developing countries and the need to, sort of help them more than sort of the developed countries. So I'm not so sure the IMF.
You disagree that the war in Ukraine might not be the most important negative factor for 2023?
It's possible it's not. I think it's a big factor, but whether it's the most important, who can say? It's their opinion that it is. And so a lot of people take these things, I heard that somebody said this, it's their opinion. It may be the most important factor, but it also may not be. So you have to kind of take it with okay, this is what they're saying. Okay, you either agree with what they say or you don't, but I wouldn't.
You're the pro, so
I wouldn't
you're saying
say
it's not the biggest.
Well, to say it's the most important negative factor, odds would say it's not the most important.
What do you think is?
It is a major factor.
What do you think?
Probably high interest rates.
Don't you think the war has something to do with that?
Sure, but not the only thing. And
okay,
so
I've tortured you enough.
I think the thing is, everybody latches on to their favorite whatever. CNBC said this. Oh, no, it's not CNBC, it's Fox. Fox said. These are all people's opinions. Right? And I think people put too much importance in any one of these opinions. You know, well, I'm getting out because of, because of this. Well, okay, how did that work out? It usually doesn't work out well.
That's not something I disagree with, but I mean, a big war and 2.5 trillion, I'd say they're onto something.
They said could cost.
Could cost, okay. Maybe it ends up costing $1.380. Who knows?
Oh, no, I know, but I'm just saying it's, a lot of this stuff, all these organizations, they're all fighting for headlines, and
They got one on you.
They do,
Yeah.
because someone says, "Oh, didn't you see?" I mean, many times I'll have someone say to me, "Didn't you see what happened?" I said, "Yeah, but."
I was about to go and bury the silverware in the backyard, and now you're causing me to doubt that. We're going to move on here to
Right.
the interest rates.
Well, a lot of places raised interest rates.
Turkey cut,
Turkey
but
cut it
Turkey
again.
always cuts.
They always cut.
How they haven't gone into hyperinflation is beyond me.
Well, they're pretty close.
They sound like Argentina.
Yeah, well, their inflation rate is like 80, 90%. But
What does this guy think is, what's he thinking?
I think, it's more of survival than anything else. If you take a look at the real world, Bank of England, Mexico, New Zealand.
Real world bank. Turkey isn't the biggest army probably outside of.
Yeah, but I mean, they're doing it for their own survival.
How is that helping their survival?
Well, it's keeping unrest down if you keep trying to keep prices lower and blame everybody else for their inflation. So their tactic is we'll keep cutting rates. See, we're trying to bring the inflation down, and it's insignificant country as far as the economy goes. If a lot of these things disappeared, I won't state my the world needs 5 countries philosophy, but Turkey would not be one of the 5.
Next month we'll.
Okay.
I'm a Liechtenstein guy myself.
Okay.
All right. Now we see the oil cut.
Oil cut was $80 at the end of the month. We're now in the first week in December. It's $72. So.
And is that not saying that it's not responding to inflation? It's responding to the fact that the economic growth is gone.
Slowing down.
Slowing
right.
down. Maybe not gone, but slowing.
Right.
Really slowing down.
Or the fear that it's going to slow down.
Drives the oil prices.
Will drive the oil prices
not
down.
that I want to buy some oil. Well, we only have so much. You'll pay this price.
Right.
What Europe's trying to do to Putin, and good luck with that.
Mm-hmm. Yep.
All right. Now, we want to get into science.
Correct.
World Series, Philadelphia versus Houston. Years following a Philadelphia win have been bad for growth and for the market. Philadelphia win, Houston loss, the following year averaged negative 10%. Houston win, Philadelphia loss, the following year averaged negative 1. The Astros won. So we're going to get a negative 1. That's not exactly something to,
Again,
jump for joy about.
we're only looking at sort of like direction.
Well, this is
Negative 1 is better than negative 10. So the
But it's
best.
still, the direction is wrong. It's not the direction we want.
Correct. But
Who did we need in the series for this to be a stellar year?
well, I will tell you, glad the Yankees didn't get in, because that would have taken days of number work, because they've been in the World Series so many times. But the sad thing about it is, we're talking about a World Series that was played in November. You probably got to shorten the baseball season.
Yeah, they all get greedy. What you need is all the for the late time of year, Philadelphia to move to Florida. Not in a time of a hurricane, of course.
Well, it's not going to the seasons are going to get longer, not shorter, based on what Aaron Judge got today on his 9-year contract. So someone's going to pay for it.
The ticket holders.
Of course.
All right, now the economy. Inflation, good news. Consumer prices are down, are up only
Yep.
0.4%,
Right.
which is
Past 12 months, and consumer prices have been up 7.7. That was down from 8.2 a month ago. So it's going in the right direction. It's still way too high, but in order to get to 2, you got to bypass the 7s, right? It's not going to go from 8 to 2. It's going to go down.
well, it could be, but that would be saying the economy
is really bad shape.
gone.
Correct.
So it could, what you're basically saying is, I don't want it to go there. I want it to go on a kinder, gentler
Generally,
track. What do you call it? Trajectory.
right. Extremes in either side are not good. You want a general slow decline, or if it's going to go up slowly, not these extremes. But we're in a world where, everybody wants the extreme. But that's good news. Inflation appears, another report will come out later this week, and then the beginning of next week. Hopefully that's going to continue to show a slow decline, which is what is needed, I think. Leading economic indicators, that's the one category that has remained weak all year. And it's basically 10 components that give a snapshot of the economy. Stock market's one of them, building permits are another, jobless claims are another, new jobs created are another, big ticket item purchases are another. That's been negative for 8 months in a row. Usually 3 months in a row would signal a higher risk of inflation, a higher risk of a recession. So at 8 months in a row, it's probably going to signal a recession sometime next year, but it might already be factored in. We've been talking about a recession for all of 2022. So when it comes, it's sort of anticlimactic. For the market anyways. I'm not saying for the...
not for mom and pop.
We're only talking about how these things affect the stock market, have nothing to do with how it affects, an individual. It's just how it'll affect the market. And it may be that it's already factored into the stock market. And that's really all we care about, because that's what we do.
We?
Well,
Your trade. Me, I do a couple of other things.
Correct.
Yeah.
Yep.
But, well, Mike
Yep.
eats, drinks, and sleeps the market.
Well,
I only once in a while.
yep.
Jobless claims.
3-month high. Finally, it appears that inflation and higher interest rates are affecting the ability to keep a job. But the big thing is, it's still not at levels that can hurt the economy. Generally speaking, you need 250,000 layoffs a week to really start hurting the economy. And even though we're at a 3-month high, last week it was still at only 225. So, we've gone through a big inflation cycle, right? Number one. Number two, we've gone through rapid interest rate hikes. Really hasn't affected the job market yet. And we saw that also confirmed with the employment report for November. We created 261,000 new non-farm jobs. History shows you only need 150,000 to grow the economy. So, that's pretty good. Wage growth is still up there, 5.1% for the past 12 months versus 4.9% the previous month.
Is it keeping pace with inflation?
It's not keeping pace with inflation, no.
There are no further questions, Your Honor.
Right.
Okay, well, we're over time a little, but
Okay.
I'm looking forward to next month.
All right.
Because if next month, which it should be a stellar month, next month when we meet, we should have had a stellar December. So everybody cross your fingers and hope. This has been the Long Wheel Report. We've been lucky to have Mike Carnevale here. This is Richard Norco. See you next month.